Hello everyone, good morning. My name is Hafiz Adebinke. I'm a lecturer for Principles and Practice of Financial Accounting. It's a new financial accounting subject. Today we'll be looking at a very important topic that will guide our attention towards this particular course. So I'll start with something like an introduction, which is accounting concept and convention. We'll also look at the presentation and preparation of financial statement, which is IS1. To start with, what are our learning objectives? At the end of this session, we should be able to explain the concept of accounting concept and convention, give us the meaning, the term, what it means. You should be able to give us a full explanation of classification of accounting concepts and convention. More so, you should be able to discuss the component of financial statement. You should be able to explain the elements of financial statement, elements of financial performance, and elements of financial position. You should also be explaining the ranges of services provided by accountants, as well as you should be able to tell me the requirements and disclosure expected for the IS1 preparation of financial statement. Let's have a brief introduction of accounting concept and convention. Let me put it this way. In a country, there's a constitution. Those constitutions, therein are embedded the rules and regulations, the do's and don'ts that is expected to be followed by constituted authority and also fellow citizens of that nature. That being said, in drawing up an accounting statement, whether they are external financial accounts or whether they are internally focused management accounts, a clear objective has to be that the account must clearly state the performance, clearly state the position of that operation at a particular point in time. So when we are looking at the principles that is followed when preparing and presenting financial statements, we talk about the accounting concept and convention. And also to follow the ATSWA, accounting concept and convention will help us to ensure that accounting information is presented accurately and consistently. This suffices me to say, when we are preparing the financial statement, when we are preparing the financial account, you need to understand the rudiments that governs the preparation, and that is accounting concept and convention. Now let's quickly look at accounting information. Let's quickly look at the flow of accounting information. Information identification flows into information recording, information analysis, and information reporting. At this level, this might look somehow cumbersome, but it is important that accounting starts from bookkeeping and it ends with reporting. And that is what we are trying to explain here. But in doing this, in getting the full details of this, we need to know what are the various classifications of accounting standards, what are the various classifications of accounting convention. For accounting concepts, we'll be looking at going concern concepts, we'll be looking at separate entity concepts, we'll be looking at money measurement concepts, we'll be looking at realization concepts, we'll be looking at periodicity concepts, historical costs, and margin and accrual concepts. So we are looking at 5 accounting concepts. We'll also look at 7 accounting concepts, and we're also looking at 5 major accounting conventions. We have consistency convention, we have materiality convention, we have objectivity, we have fairness, and we have prudency. The prudence concept is also called convention of conservatism. Now, it depends on the material that you have. Some can use it as concept, some use it as convention. That's for prudency. But what matter is, following the ICAN scheme of work and their listing, we have come up with what is examinable, what is expected of you as a student of ICAN. These are the 7 major accounting concepts that we have, and we have 5 major accounting conventions. Having explained earlier that accounting concepts are principles, are axioms, they are postulates that we follow while preparing financial statements. So what are those principles? Let's now look at them one after the other. The first principle we'll be looking at is going concern concept. To us as an accountant, this concept is very germane. It helps us to have a belief that this organization will continue to exist for a foreseeable future of time. That this organization will not end operation in a short time. It's not that on the verge of cessation. As accountant, we believe unless that there is evidence to contrary, that a company is not going to grow. This has important implications for business valuation of assets and liabilities. In a nutshell, going concern principle or going concern concept explains that when preparing financial statements, the financial statement should be prepared on the assumption that the company will continue to exist and not that on the verge of cessation. The second concept is what we call separate entity concept. Separate entity concept is also known as business entity concept. By separate entity concept, what do we mean? In company law, this is also seen as what we call corporate personality, artificial person. In accounting, we believe that the owner of the business is different from the business itself. So what you are reporting is transaction that relates to the business and not that of the owner. In a nutshell, we are explaining to you that as an accountant, whether the owner is a good man, whether the owner is a good woman, whether the welfare of staff is taking cognizance of, whether it's not taking cognizance of, has no basis in your reporting. Your report should focus only on transactions that relate to the business. That is what business entity is talking about. Corporate entity is a concept that seeks to ensure that private transactions and matters relating to the owner of the business are segregated from transactions that relate to the business, which means what you should record is that transaction that is business concern in nature. Money measurement concept is the third concept we are looking at. From the word money measurement, accountant, what we report is money. Whether the management is doing good, is doing bad, it will not be a focus of financial statement. Yes, in the advanced accounting, there's what we call integrated reporting, right? But that's not the subject of today. But what you need to know at this level is that what you report in accounting must be monetarily measured, must be quantified in monetary terms. If that cannot be quantified in monetary terms, it should not reflect in the what? Financial statement. An accountant do not account for items unless that can be quantified in monetary terms. Items that are not accountable for, which include workforce skills, morale, market leadership, brand recognition, quality of management, etc., are not reported in the financial account. What you report is those things that relate to finance. A very good example: sales, purchase, asset acquisition, asset disposal, payables, receivables, and so on and so forth. These are things that can be quantified, that can be expressed in monetary terms. Realization concept. Apologies. This can be seen as concept, also can be seen as convention. But we are looking at it as a concept here. So, as an accountant, when should you recognize revenue? That is what realization concept or convention, as the case will be, is explaining to us. Revenue should be recognized at the point of sales when transaction, legal ownership, and title ownership have been transferred to the third party. That is when you should recognize revenue. When transaction at the point of sale is transferred to the owner, that is the risk and benefit associated with that item is transferred to the owner. That is when revenue is recognized in accounting. In advanced accounting, we'll be looking at IFRS 15. IFRS 15 is that standard that came to replace IAS 11 and IAS 18. Both talk about revenue recognition. That is revenue recognition from contract with customers. So there we'll be looking at model with which we have to follow when we're recognizing revenue. But for the purpose of our concept and convention topic, recognition convention or recognition concept explains the basis with which you recognize revenue in your book. And that is when item transfer of ownership and beneficiary have been made to the third party. That is when the risk and benefit associated with that item have been transferred to the owner. When the ownership have also been transferred to that buyer that is the third party. Periodicity concept. Periodicity concept is another important concept that you need to know as an accountant. This explains to us that while you are preparing your report, it should be a function of a period. You are reporting it monthly, you are reporting it weekly, you are reporting it quarterly, you are reporting it yearly. Organizations should agree on which period to prepare their account. So periodicity concept is that concept that explains that a specific period must be considered when preparing a financial account. Historical cost concept. This in some textbook is seen as convention also. It explains to us that accountants make reference to cost of acquisition. Accountants make reference to what? Cost of acquisition. As an accountant, when you are giving a report, when you are trying to account for item of revenue, item of expenses, item of asset, item of liability, you consider what? Initial recognition as cost. This maintains that cost is the appropriate basis for initial recognition. So let me give you a very good example. If I purchase a motor vehicle worth 2 million naira, that's the purchase price. I cleared it at the port with say 200K. I need to add it to the initial cost. I carry the motor vehicle from the port to my office where it will be put to use. Let's say 300K. Out of that was 2.5. The total cost of acquisition of that item, the attributable cost to put it to use is what? 2.5. So as an accountant, that is what you use to recognize as cost. So it's very important that cost form the basis of your recognition when it comes to costing of items. Matching or accrual concept. What do we mean by matching concept? Is it the same thing as ATSWA concept? The answer is yes. Some authors, in their own material, they differentiate them. Some, they bring it together. Following the ICAN syllabus, I am also looking at it as one. Matching concept or ATSWA concept. When we get to IAS 1, we talk more on ATSWA. Income should be properly matched with expense in order to determine what profit for the period. That is what matching concept is all about. You match your income against your expense to properly determine the what? The profit. Now, which income are you matching against the expense? Is the income that relates to that period you are reporting. Is the expense that relates to that period that you are reporting. That is where ATSWA concept comes in. So both matching concept and ATSWA concept explain the same basic. That transactions should be recognized in the period they relate. And to determine the profit for that period, match the income against the what? Expense. That marks our accounting concepts. Now let's look at accounting convention. The first one we are looking at is consistency convention. What do we mean by consistency convention? In principle, consistency convention explains to us the basis of recognizing an item using similar method, similar approach on a yearly basis. For instance, if you are valuing inventory using first in, first out, continue to use that method. Don't use first in, first out in 1 year and use weighted average in another year. And use last in, first out in another year. The method you use must be what? Consistent over a period of time. That is what consistency convention is explaining to us. Another example I may give you is that of depreciation. We have close to 7 methods of depreciating an asset. If you have picked straight line method, please continue to use your straight line method. Don't use straight line method in 1 year and in the second year you use reducing balance method. In the third year, you use some of the year digit method. No, you have to be consistent with your principles. You have to be consistent with your method. That is what consistency conversion is talking about. Prudence convention. This is also known as convention of conservatism. So when they say accountant, you guys don't want to spend, you guys are prudent. This is what we're talking about. Prudency concept or prudency convention explains to us that when you are recognizing your profit, be careful. Don't over recognize. Profits are not recognized until a sales has been completed. In addition, a cautious view is taken for future problems and costs of the business. Now, what we are saying is this. Adequately recognize costs, but be cautious when you are recognizing what? Profit. That's what prudency convention is talking about. Materiality convention. What do we call materiality convention? In accounting, the word materiality is very significant in its meaning and in its nature. So materiality has to do with what you as organization see or have declared to be material. So it varies from company to company. Materiality convention is an important convention. As you can see from the application of accounting standards and accounting policy, the preparation of account involves a high degree of judgment, where decisions are required about the appropriateness of a particular accounting judgment. The materiality convention suggests that this should only be an issue if the judgment is significant or material to the user. The concept of materiality is an important issue for auditors of financial accounts. So materiality convention, like I explained earlier, when reporting financial statements, when reporting some transactions, you consider their impact, you consider their significance for you to report them. So as auditors, we use this as the basis to determine which account is significant, which account is not significant, which account is of high risk, which account is of less risk. Objectivity convention. For objectivity convention, we are explaining that as a accountant, you must be honest. You must be honest. You must be independent while you are preparing your financial statement. Your financial statement should have a verifiable supporting document, and you must be objective in doing it. There's a close match with fairness convention. So you look at objectivity, is talking about what? An accountant must be independent in preparing his financial statement of his prepared financial account. While doing so, he must ensure that the document he has must be verifiable supporting document. Else, that principle of objectivity is not followed. Now, fairness as a convention is also talking about where we have a lot of users of financial statement. Your report should be free and fair for everybody to be able to enjoy it. What am I saying? Your report should be able to cater for the different needs. Don't focus your report on one particular people to satisfy them. Your report should be fair enough to accommodate the real financial performance, the real financial position of the organization. It must not favor any group or any segment in the society. What are the key characteristics of financial accounting information? Before we go into the key characteristics of financial accounting information, let's do a recap of the accounting concepts and the accounting conventions. The first one we'll be looking at again as a recap is going concern. Going concern concept is that principle that we as accountants use to assume that an organization will continue to exist for a foreseeable future period. Separate entity concept. This concept explains that while preparing your financial statement, only record that transaction that relates to the business and not that of the owner. The business and the owner are two separate entities. Focus on that relates to the business and not that of the money measurement concept. This concept explains the importance of recognizing that item that can be quantified in monetary form. Once an item cannot be quantified in monetary terms, it should not be recognized. Realization concept. This concept explains to us the basis of recognizing revenue. As a company, when you are recognizing revenue, to recognize revenue in your book, ensure that ownership to the item has been transferred to the third party. Ensure that risk and benefit associated to the item has been transferred to the third party. If that is done, then you can recognize revenue. You can recognize income. Periodicity concept. This concept explains to us as accountants to identify a specific period for reporting, whether monthly, whether yearly, whether quarterly. Ensure that your account prepared is for a specific period. Historical cost concepts. Accountants make reference to cost of acquisition of an asset. And when you are determining the cost of acquisition of an asset, you consider the initial cost of acquisition and the other attributable costs to bring the asset to a usable condition or for its intended use. Matching or accrual concepts. Expenses, income should be recognized in the period they relate. To determine the profit for that period, match all income against the expenses for the period. There's also what we call dual asset concept. It's not identifier. The dual asset concept explains to us that accounting has two sides. Dual. It has debit, it has credit. It has a party receiving, it has a party giving. For every debit entry, there must be a corresponding credit entry and vice versa. Accounting conventions. For the purpose of this lecture, we are looking at just 5 major accounting conventions. They can be more than, but for our course content, we have 5. Consistency, materiality, objectivity, and fairness. Prudence. Consistency explains that as an accountant, ensure that you are consistent with your method. Ensure that you are consistent with your basis of reporting. Don't use one method this month and use another method in another month. Ensure that you are consistent in your basis of reporting. Materiality. I mentioned to us that materiality convention is very key. Is very key. And the concept of materiality is germane to auditors. So as auditors, when we are trying to determine the risk associated to an item, whether to classify it as significant or non-significant, we need to consider the materiality of that item. So in accounting, materiality is very key, and you must consider it while preparing your financial statement. Objectivity convention. Objectivity convention explains that while preparing your financial statement, 1, you must be independent. 2, you must ensure that supporting documents used in preparing that financial statement are verifiable. Fairness. Fairness convention explains that while preparing financial statement, you must be honest and ensure that your report did not favor one party as against the other. Your report must be able to take account of everybody's needs. Prudency convention. Prudency convention explains that as an accountant, be cautious in recognizing revenue. Ensure that transaction is completed before you recognize its revenue. But of course, ensure that adequate costs associated to an item is properly recorded. Now we can now look into another core subtopic, key characteristics of accounting information. What are the key characteristics of accounting information? Well, to determine the characteristics of accounting information, you need to ask yourself a question. Who are the users of the accounting information? Are they really benefiting from the use of accounting information? For them to benefit, what are the core points that must exist? What are the core things that must be in existence? What are the ingredients or principles or maxims or criteria that must be satisfied? If we have those criteria, then we cannot say information is relevant for decision making. Information is useful, is adequate enough to permit a sound economic decision. Number 1, understandability. Financial statements must be understandable enough for the user of financial statement. Even though you are not accounting oriented, your presentation must be so clear and faithful enough for people to understand. That is what understandability is talking about. It must be clear enough. This principle implies the expression with clarity of accounting information in such a way that it will be understandable to users who are generally assumed to have a reasonable knowledge of business and economic activity. Relevance. Information will not be useful if it's not relevant. And how do we determine relevancy of information? How do we determine the relevancy of information? It's when that information is useful. It's when that information is correct. It's when that information can have a valid data that can make us predict the future. That's what relevance is all about. Yeah, we talked about consistency earlier. It's also a key characteristic to financial information. The similar approach to the application of accounting policy must be the same year in, year out. Comparability. In practice, we do what we call comparison of financial statements. Year in, year out, you compare. To be able to understand the growth, the performance, and the movements. Month in, month out, in some organizations, they prepare reports and they compare. So a financial statement must help the users to be able to compare that information with another company of the same business nature. And that is, for instance, if I pick up a financial statement of GT Bank and I compare it with that of First Bank, I should be able to make a decision. And who is making more profit? Who is not vulnerable? Where can I invest my money? These are various questions that we come up while comparing financial statements. Reliability. For an account statement to be reliable, that account must be prepared in a true and fair manner. That is, the information therein are truthful, are accurate, and complete. Nothing significant is missing out. Then we can say that information is reliable. Lastly, objectivity. We talked about it earlier. When information should be objective in accounting, that information must not be biased. It must not be biased. It must be independent. The two parties or any parties involved must be able to take that decision as valid and not that favors one as against the other. It must be neutral. So the conceptual framework gave us a chart to determine the qualitative characteristics of accounting information. Two things are there, right? But in my first slide, I explained it in general. But here, we are looking at it like a body in a tool that has its line and drop down. Relevance. It must be predictive. You must be able to predict the value. I talked about it earlier. You must be able to confirm the value, confirmatory value. Materiality. I've explained this earlier also. I also talked about faithful presentation while talking earlier. It must be so objective enough. And the parties involved must be able to make a decision with it because it is free from error, it is neutral, and the information is complete and accurate. Down the line, We have comparability, we talked about it earlier. Verifiability, we talked about it, where we say the document must be what? Verified. That is, you must have a supporting document for all the reports you are preparing. Timeliness, yeah. Timeliness has to do with the ability to make the financial statement ready as at when needed, real time. And lastly, understandability. We explained this earlier that a financial statement key characteristic is that it may be what? Understanding. Now we are looking at introduction to International Accounting Standard number one, IAS1. What is IAS1? Why do we need to look at IAS1? Is it important we look at it? The answer is yes. But you can also ask yourself, I've already talked about accounting standards and conventions. So why am I going again to IAS? Why am I going again to IAS? Right? Because as accountants, the principles that we follow while preparing financial statements are the standards. And this standard must be at any point in time be complied with. In Nigeria of today, we have a regulatory body, Financial Reporting Council of Nigeria. And I believe this has been explained well while we're in ATSWA. So at this level, what I don't need to do is to further the discussion given to us in ATSWA. At the moment, we have 41 IAS, that is International Accounting Standards from number 1 to number 41. So there are listed item of standards that were expected to cover in ATS2. One of it is what? IS1. What is IS1? IS1 means presentation of financial statements. Why is it important for us to learn IS1? It is important for us to learn IS1 because it's a standard that it needs to be known by you before you start to know how to prepare financial statements. What are the provisions? What are the requirements of IS1? IS1 set out the overall requirements for the presentation of financial statements, guidelines for their structure and minimum requirements for their content. IS1 permits us or explain to us basis of recognition, measuring, and how do we disclose specific transactions that are addressed in other standard applications. What are the provisions of IS1? What are the scope of IS1? IS1 applies to all general purpose financial statements based on the International Financial Reporting Standard, IFRS. General purpose financial statements are those intended to serve users who are not in a position to require financial support tailored to their financial particular information. Here, a very good example are the bankers, the shareholders, government authorities, the stakeholders as a whole. What are the objectives of a general purpose financial statement? Is to provide information about the financial position, financial performance of an entity that is useful to a wide range of users in making economy decision. You will ask me that why did I underline financial position, financial performance, and cash flow? Because these are the core components of financial statements. The financial position is what we used to know as balance sheet, which is now generally acceptable to be called statement of financial position. The financial performance explains that part of accounting preparation that we call profit and loss account. So we use profit and loss account to actually ascertain financial performance. That is the profitability worthiness of an entity. Are they making profit? Are they making loss? We understand that using preparing what? Profit and loss account, which is now known as statement of profit or loss and other comprehensive income. Cash flow statement, even in practice, this is more important to a business plan. But a businessman wants to know how much is coming in and how much is going out. That statement that shows the total amount of money received and how those money are spent is what we call cash flow statement. It helps to ascertain the liquidity position of an entity at a point in time. Whether or not an entity can pay as short-term debt as an entity, you can only ascertain that using a cash flow statement. Let's look at the flow of a full financial statement. We have the assets, we have the liability, we have the cash flow, we have the equity, we have the income and expenses, including gains and losses. And we have contributions and distribution. Contribution by and distribution to shareholders. Shareholder, that's the owner of the business. So this particular chart here explains to us a component, element that we can see in a financial statement. You can see an asset in a financial statement. An asset in the financial statement, you can also see a liability. You can see that part that we call equity. You can see that part that we call cash flows. You can see that part that relates to income and expenditure. And you can see that part that relates to contribution and distribution to owners. Let's appreciate the component of the financial statement. A complete set of financial statements should include, at every point in time, 5 major components. So, examiner may ask you, list the 5 components of financial statement according to IS1. If I ask to list the component of financial statement according to IS1, you don't need to count, just pick your pen and list all that I have there. Number 1, statement of financial position. Number 2, statement of profit or loss and other comprehensive income. Number 3, statement of changes in equity. Number 4, statement of cash flows. And lastly, note comprising a summary of accounting policies and other explanatory notes to the account. Let me take it again. The component of financial statement include the statement of financial position, the statement of profit or loss and other comprehensive income, the statement of changes in equity, the statement of cash flow, and notes comprising a summary of accounting policies and other explanatory notes. Now, what are the presentation requirements? Just like what I mentioned earlier. The presentation requirements include state clearly statement of financial position, state clearly statement of profit or loss and other comprehensive income, state clearly the statement of cash flow, state clearly the changes in equity, and lastly, notes to the financial statement. In the note to your financial statement, you will have what and what. You have the full details of accounting policies, the explanatory notes in preparing the financial statement That is the breakdown of balances that you have will be set, will be shown in the notes to the account. And let me explain them one after the other. What is a statement of financial position? A statement of financial position is that we call balance sheet. Before now, it is known as balance sheet, right? But now it is called statement of financial position. In it, we have the assets, we have the liabilities, and we have the equity. Assets, I mean the non-current asset, which is formerly called fixed assets, and the current assets. We have that at the asset side. Other liabilities, we have two types. Non-current liabilities that we used to call long-term liabilities, and we have what we call current liabilities. Lastly is equity. How do we get our equity? Equity refers to the residual interest in the business after deducting what? Liability from asset. That after you are taking out liability from asset, whatever that you get to go is for equity. That is our accounting equation comes from now. As equity equals to asset minus liability. Statement of profit or loss and other comprehensive income helps us to determine the financial performance. By performance, we mean whether a business is making profit or is making loss. You will know through the statement of financial, statement of profit or loss and other comprehensive income. Cash flow statement, statement of cash flow, as I earlier mentioned, shows us whether or not an entity is capable enough to pay a short-term debt. In a cash flow statement, according to IAS 7, we have three major subheadings. We have operating activities, we have investing activities, and we have financing activities. Cash flow statement shows the revenue generated, the inflow from all of these headings, and also their respective outflows. Cash flow statements report on cash basis, those things that are due to inflow and outflow of cash alone. Statement of changes in equity. The statement of changes in equity shows reconciliation of capital structure of the company, where we have the opening and we have the closing. It also shows us the changes during the year. Lastly is notes to the account. The notes to the account, like I explained earlier, it shows the notes such as the accounting policies, the breakdown of balances that normally, for instance, revenue is 50 million, the breakdown of revenue, note 1, you go to note 1, you see what and what is added together to give us the element of financial statement. Let's take a brief look at elements of financial statement. Elements of financial statement simply refers to as those parts of the components of financial statement. I've explained this earlier. The elements of financial statement are just 5. However, we can further categorize them into 2. Element of financial position and element of financial performance. The first 3, asset, liability, and equity, represent the element of financial position, while the last 2 represent the element of financial performance. Why do we say the first 3 represent element of financial position? Because they are reflected in the statement of financial position, that's the balance sheet. Why do we say the second one are called elements of financial performance? Is because they are also reflected in the words, in the income statement, profit and loss account. They are simple as that. Now let's have a clear vision of it. We have assets, we have liability, we have owner's equity, that's share capital. We have revenue and we have expense. I believe at this level, we don't have question as regards to elements of financial statement, elements of financial performance, because we've explained this earlier. But let me take it again. The element of financial performance relates to that we have in the income statement. That is the income and the expense. It is called element of financial performance because it helps us to determine whether an entity is making profit or not. Element of financial position explain to us those items that we have in the balance sheet. By subhead, we have the asset, liability, and equity. Accounting basis. What are accounting basis? What do you mean by accounting basis? What do you mean by accounting basis? Is it different from accounting concept or convention? The answer is no. Apologies. The answer is yes. Every business record revenue and expense into its financial statement at a specific period. This timing of documentation is what we call the basis of accounting. At what point should we recognize revenue? At what point should we recognize payment? At what point should we recognize this? At what point should we recognize that? So that is what accounting basis is talking about. It's explaining the totality of our approach that an organization will use in order to determine the value, the time value, the timing of when transaction is to be recorded. So we have two major bases. We have cash basis, we have accrual basis. In your ATSWA here, you will be taught government accounting. So in government accounting, we have close to 5 bases of reporting transactions, such as cash basis, accrual basis. We have what we call commitment basis. We have what we call modified cash basis, modified accrual basis. But for accounting purpose alone, for financial accounting, we have just only two: the cash basis and the what? Accrual basis. For cash basis, when should you recognize transaction? Recognize transaction only when cash is being paid or when cash is being received. So when cash is paid, recognize payment, that's expenses. When cash is received, recognize income. For instance, revenue. Accrual basis. For accrual basis, income and expense is not recognized when cash is being paid or cash is being received. You recognize it when they are incurred or when they are earned. So now you recognize expenses when it is earned. You recognize income when it is, apologies. You recognize expenses when it is incurred. That's the right word. You recognize expenses when it is incurred. You recognize income when it is earned. At that point in time, you recognize it based on what we call accrual basis. So under accrual basis of accounting, recognize income and expenditure when they are earned, not necessarily when they are paid, when they are received or paid. By implication, income and expenditure are recognized in the period they relate to, irrespective whether they are actually being received or paid. Time to recap. Let's have a quick recap. Let me take that part of accounting basis again. In accounting, we have two bases of accounting: cash basis and accrual basis. Cash basis measures that accounting should be recorded when cash is received. Recognize income when cash is received. Recognize expenses when cash is paid. That is what cash basis is all about. Movement of cash flow. Now, accrual basis explains that recognize income and expenditure when they are incurred or earned. For income, once income is incurred, recognize it. Not necessarily when they are being paid for by customers. For expenses, Once they are incurred, that you are sure that this will be paid, maybe now or future, recognize it. And transaction must be recognized in the period they relate to. Thank you so much for attending this class, which I'll share with you the link of this video, which you are going to have as a recap for all that have been discussed in today's class. Thank you and God bless. Good day for now.